I'm a partner at King & Spalding. I do primarily real estate finance work, and I'm gonna start by introducing my panelists here. Abby.
Hi, I'm Abby BOROK. I'm with BentallGreenOak. BentallGreenOak is approximately 70 billion AUM real estate asset manager. We're investing globally across both equity and debt strategies. I head up our US debt business, where I'm focused on investing in value-add real estate debt transactions, as well as managing a core portfolio on behalf of our captive insurance company, Sun Life.
Great. Jillian.
Thank you. Hi, I'm Julian Marieuti, and I work on the capital markets team in New York for JLL. JLL is a large commercial real estate firm, and I work specifically on the debt and equity, where I work closely with owners and developers in structuring their debt and equity across asset class. So that's multifamily, hospitality, industrial, you name it, and across construction through stabilized permanent financing.
Lisa.
My name is Lisa Patterson. I'm a managing director in U.S. credit for Oak Hill Advisors. Oak Hill Advisors is a 55 billion AUM company which focuses on multi-strategy investments, and we are building out a commercial real estate platform for the first time.
Great. So, I'm sure what's top of mind for everyone here, I guess first just the fact that we are all here together at a conference for the first time in a long time. Having worked remotely and sort of being in this pandemic for 18 plus months, wondering if you could speak a little bit about how the experience has been for you and how that's affected your work, and particularly for Abby and Lisa, because you guys actually started new jobs and are building new platforms in the middle of a pandemic. So maybe you could speak to that for a few minutes.
Sure. So yes, I started with BentallGreenOak 5 months ago, so right in the throes of the pandemic here. I'd say what's maybe a little bit unique about BGO is that we actually were back in the office. So since I started in May, we have been in the office at least 4 days a week, have brought back the investment and capital raising teams. So that I think is a little unique and has been great as we build a team. There are a lot of challenges around building a team, creating the right culture, having the collaboration that you need in order to bring everyone together to make the right investment decisions. So it's definitely been a challenge both on the people side, and then I spend a lot of my time out in front of investors, either sponsors who are investing in commercial real estate and I'm looking to lend to them, or investors, institutional LPs that are looking to invest in our funds. And that's very difficult as well because we're used to being in front of our clients and explaining our business day to day, and there's a lot of Zoom and a lot of challenges associated with that sort of communication. We're getting through it, but it's a challenge.
Lisa.
Yeah, I would say that I also started at Oak Hill about 5 months ago, and starting at a new company first and foremost, learning the people, learning the environment, and trying to get them learn to know me and what my skill set is, and translating culture and things of that nature is really difficult from a technology perspective and just an EQ perspective. And so, in my mind, there's a part of me that does believe that the future is hybrid, and I believe in fintech and technology really leading a lot of commercial real estate moving forward. But I don't think you can really work in commercial real estate and not truly believe in the return to office and the return to work story.
Yeah, absolutely.
And Jillian, how's your experience been throughout this?
So I will echo what my fellow panelists are saying. In essence, you can sustain a business the way we were outside of the office because technology has improved. To be able to meet with people you already have met and know through Zoom was pretty great. And it was really impressive to see some virtual tours done with the technology. I mean, I saw some videos where you really felt like you were in the building, so that was great. But you cannot grow a business without that face-to-face contact. So I'm definitely supportive of being in the office. I personally have been back in the office every day since last Labor Day, and I really truly believe you are most productive there. You learn through other people and through osmosis, and that's crucial, and you cannot replace face-to-face.
Yeah, I would add, as a manager, I would definitely say that if you look across your team, any individual I think can be very productive at home on Zoom and at times productive in the office, but as holistic view of a team or a company. I just think the productivity that comes with being able to have junior people in the office and learn from collaborating and the just kind of informal working environment that you get, I think has really, that productivity is important, and you don't get that just being remote.
Yeah, I think the the osmosis is key. I mean, I remember as a junior associate lawyer, just learning things from open doors, right? And like hearing people arguing on conference calls as I'm frantically writing things down, being like, what is this? So yeah, I think that's nice to see coming back, and nice to appreciate. Sort of on that theme of coming back, you know, we're all back here, we're back in the office for the most part, and it really does feel like the industry is back in like a huge way. I mean, we were all just talking about, you know, how hard it is even to just kind of carve out some time to be here. We're so busy. Maybe you can speak about, you know, how it's come back where you are now, and what you think the reasons for that is. Is it pent-up demand? Is it, you know, the interest rate environment? Is it people trying to do things now before we sort of all go back? Yeah, Jillian, you want to give your thoughts?
Absolutely. So yes, there's absolutely no debate that 2020 had its impact. For JLL, specifically on the debt team, say we did $50 billion in debt compared to 88 the year prior. So naturally there was an impact and less transactions and less financing that were occurring. This year, we are already starting to see that volume look a lot closer to 2019. And there's a few themes and reasons for that. One, there's extreme amount of liquidity in the debt and equity markets. There's a lot of capital out there, and it's for all asset classes. Two, I would say the cash flowing assets, those with leases with weighted average lease terms longer than 5 years, there's a lot of capital chasing those, and therefore spreads and pricing has come in and compressed. And then non-cash flowing assets are definitely getting financed too, because lenders are either believing that they are in a market where there's rent growth, or they're seeing leasing on the horizon. Another theme we're seeing that's keeping us quite busy is ESG. The trend to environmentally friendly assets is definitely continuing to grow, therefore improving and creating more price aggression in that arena. And then the last theme I would say that is definitely contributing to us being so busy. So I mentioned there's a lot of capital and a lot of liquidity out there. What does that mean? There's $290 billion of dry powder on the sidelines. Just to give you context, that compares to $87 billion back in 2008. And because of that, and a lot of capital is chasing these in-favor sectors such as multi and industrial, you're starting to see frustrated capital drive capital now towards office, retail, and hotel. For example, JLL Hotels team is out in the market on $4.5 billion of hotel financings across acquisitions, refis, and hotel construction. I personally just closed 2 hotel construction loans. I'm in the market right now on a hotel that didn't open yet. It's right at TCO. And there's capital that is showing up that wasn't showing up 60 days ago. So that could be a result of a little bit of this frustrated capital theme, and also just people feeling like metrics are stabilizing and improving.
And on that dry capital point, I mean, being at, like Lisa, being at a fund now versus being at a bank and having access to this, you know, immense capital, how have you been able to structure deals and sort of put that capital to work?
Yeah, you know, the interesting thing was when we were first pitching what our strategy was going to be in building out this platform, you know, in December or January, I think, you know, at that point in the pandemic, we thought that the distress was actually going to be a little bit deeper than it ever came to be. And, you know, everyone was kind of scratching their heads with, you know, the amount of stimulus that was injected into the system and saying, okay, you know what, the market never really felt the distress that we were all hoping to see. And so when you think about building a new platform with the amount of competition that's out there, and competition especially from like the debt fund space, who, you know, if you see traditional A-note lenders that are looking into the market and basically saying, okay, my spread is, call it mid-2s, you'll have the debt funds that now can bid a unitranche piece of paper where they can repo finance in, you know, call it the low to mid-1s, and your traditional A-note finance lenders can't compete with that. So you have to be very strategic in terms of which opportunities you're looking for, where the yield can actually be. And right now, to Jillian's point, that's kind of driving people to, you know, some of the asset classes that in a post-pandemic environment you thought would be a little bit more out of favor, like hospitality, retail, even office in certain senses. So you have to be diligent, you have to pick your spots, and you have to be patient. And you're seeing a tremendous amount of discount on structure right now. And so if you're going to stay active in these markets, you have to see what you're comfortable with and really hold the line.
And Abby, what's your
Yeah, I would say
strategy
there's a lot of competition out there on the debt side. What I would say, and from the alternative lender or debt fund perspective, some positives are that the pie has gotten so much more heavily weighted towards debt funds. So traditional lenders like banks, like life insurance companies, really have had a change in their credit culture, and as a result are not as big and prolific lenders in the markets as they used to be. So the piece of the pie that's been taken by the debt funds and the alternative lenders has just grown over this last cycle, and I think that that's been accelerated by COVID because many of those debt funds performed quite well. There was a lot of resiliency across debt funds in this black swan of all black swan events. So I think that it's that debt and alternative lending has just become a more accepted asset class for investors. When I'm out talking to investors, whereas 5 or 7 years ago, they understood real estate private equity, they understood the public REITs and the public markets, but they didn't necessarily understand real estate debt. I think that's changing.
And where do it certainly is very visible that the structure is kind of the first thing that we all have to live without to compete here. And as working on construction loans and unstabilized assets, it's just it's incredible what we are getting comfortable with where we were 6 to 9 to 12 months ago. For Lisa and Abby being at funds, I assume you are still working with banks in terms of like your warehouse lending and your repos or note-on-notes. How are you finding that they are getting comfortable with leveraging your slightly less structured loans?
It's been, I would say it's been a little bit of a mixed bag, and it depends which bank you're working with. But I would say in general, the banks have a tremendous amount of capital available for repo financing. And so the types of structural deficiencies that they're willing to absorb, I think I've been a little surprised by. And so in general, I haven't seen a slowdown in the amount of people that are willing to bid either note-on-note financing or repo and warehouse financing. And it's been at really attractive spreads.
Wow. Yeah.
Yeah, I would argue that the banks are just outsourcing what used to be their direct real estate lending to the alternative lenders. So they can hold the warehouse lines on their balance sheet at capital, taking capital charges that are very attractive. And they can probably make more money lending to me at L200 than they could doing a direct real estate loan at L300 just because of the regulatory environment. So I think that that's part of the nuance there.
So Jillian, what are you seeing then as the hardest asset class to finance? I mean, to this, I would have thought hotels, or office space, but I think that there's still an appetite for that. Is there anything that you're seeing that is hard to move?
To my first point about just there's so much capital out there and it is available for all asset classes, you are seeing deals get done across asset classes for strong sponsorships and good location. But I guess what I'll do is answer that question by taking a look at the different type of lenders out there and how they're looking at things and how they may have changed the way they are approaching the market. So the different type of lenders, one, there's agency, right? They lend on multifamily product, your Fannie, your Freddie. They had a banner year in 2020. They were up 18% from the year over year. They were the only lender that increased activity that year. This year, you're seeing a lot more competition with life companies and banks getting more aggressive, leaning in, and really forcing these agencies to tighten up their own pricing. We expect the second half volume to be a little bit more than the first half for agency. In fact, July 2021 was the highest marked volume for Freddie securitizations on record. So that's definitely an indication we'll see a strong second half from them. Second type of lender out there. Let's look at life companies. Their emphasis is still on cash flowing assets. So it's not, they're very much focused on your multifamily and industrial. How are they winning business? because they're starting to quote loans at tighter debt yields for the multi and industrial product so they can beat Fannie and Freddie out and other banks and really win the business. And it's been working because the life companies are up 48% this half, the first half of 21 versus last year. CMBS, we all know in 2020 there was this gap. There were a couple of months where it just halted, and that impacted the volume in 2020. There was $60 billion in CMBS. That was a 40% decline to the $100 billion that they did in 2019. We're now on pace closer to that 2019 volume. I would tell you SASB, so for the students out there, that's single asset, single borrower, makes up the majority of the CMBS volume that we're seeing this year. I would say they are winning the large loans greater than $250 million for the shorter term deals, pricing at 150 to 220 over the corresponding benchmark. And like I said, I think it's over 60% of the CMBS volume this year, so that's been very competitive. The debt funds, which we've already talked about, the alternative lenders, they're exceedingly competitive. There's actually more funds this year than last year. I believe 82 versus 74 last year, so you're seeing more players show up, and pricing continues to compress and get aggressive, not only because of the competition, but also because bank credit lines are lower, and you're also seeing the CLO market strengthen. And then finally, banks. The local regional banks were leading the charge. Commercial banks are coming back to it for sure, waving in your stabilized product as well as construction. They're very relationship driven. But I'll tell you, in the last 2 months, JLL's volume, 40% has been banks.
Wow.
You're seeing this interesting time where the debt funds and the alternative lenders can actually take part in a market like the multifamily market, where Fannie and Freddie used to basically dominate all of those deals just because of the volume and the spreads that they could give. But you're seeing this interesting phenomenon right now where, if you're looking at, future rent increases and stabilized growth, right, and a takeout lender is basically underwriting to a sub 6% debt yield, what you're seeing is all of a sudden the debt funds can come in, whereas the agencies are going to basically look at it and say, I'm capped at like a 125 debt service coverage ratio, right? So they're only going to get you to 50% of cost or something along those lines. So you're seeing an interesting place where now alternative lenders can sweep in and take part of an asset class that historically they would never used to see a ton of. So it's just an interesting thing that's happening right now.
Yeah, and what are you hearing from your borrowers, and Abby, maybe you could address this, in terms of their wants, right? It's clearly a borrower's market. They want no structure and all the proceeds, obviously. But, what is really what they're looking for with the is it a cash out? Is it, the least structure possible? Is it the tightest spreads? I'm sure it's all of it, but what is winning the business at the end of the day?
It is, and that's part of being a lender.
Yeah.
You're going to get asked to go, as low as you can go. But I'd say what I think a lot of borrowers continue to come to the alternative lenders and the debt funds for is, one is flexibility. So we're financing a lot of groups that are executing on value add business plans. So they're investing in the asset to either stabilize the cash flows or upgrade the physical plant through CapEx, but going through some sort of business involved or complicated business plan. They want a structure for the loan that's flexible. And many times if they go to a bank or to another traditional lender, that's very hard to get. So, providing them the ability to invest equity alongside the debt to help their IRR, or looking at, the timelines that they need to complete the work and being flexible. That's super important to them. And I think that borrowers have continued to see that alternative lenders can provide that. I also think that post-closing on loans, so that's a big component of what borrowers are thinking about. Once I close the loan and I have to go through this whole business plan, who am I going to be able to have on the other side of the phone to talk to when the business plan changes? Or I need more money for this tenant, or something changes. So the asset management side, I would argue that alternative lenders are also pretty good on that side of the coin as well. The work really starts when the loan closes. We try to understand what the structure was, what the business plan was, so that we can be flexible going forward and provide that level of customer service to the borrowers. post-closing.
Absolutely. And I would also add to that that a lot of folks will lean towards a debt fund alternative lender if they want more leverage. You guys tend to be able to go up the stack more and give more proceeds. So once again, depending on the borrower's needs, whether they're rate sensitive or proceed sensitive, that's also going to indicate what type of lender that I just walked through will probably be most competitive. And if they do in fact want more flexibility and higher leverage, you're often seeing these alternative lenders be most competitive.
And Lisa, how do you find then internally you win the deal, and get it credit approved, right? Because it's always the give and take of the borrowers want this, but you have to go back to your credit committees and your investors and your lenders, and how are you getting them comfortable with the less structure and.
It's definitely an educational process, especially being at a true credit buy-side shop, right? It's a very different underwriting than being at a CMBS lender where I spent a very large part of my career where it's, the analysis is, can we sell it? So when you're talking about a true buy-side full credit shop, you have to explain to them, one, where the market is, and if the market is bearing something, should you meet it? If you want to stay active and stay relevant, yes, you should, not in all cases. But it's a discussion around what's the risk profile, who's your sponsor, who's on the other side of the table from you, right? And so I think if you're thinking about, an institutional sponsor versus somebody that's maybe not as institutional, it's a different credit analysis. So it's a much different overall underwriting of the risk and the transaction.
And where do you see, now sort of looking ahead for, let's do the first the next 6 months to 12 to 18 months, how do you see this continuing? Jillian, what are you hearing from folks?
Sure. So I guess I'll opine a little bit on the interest rate market. I spent 10 years on the interest rate derivatives desk, so I can't not opine on it here and there. I think interest rates are probably going to still stay low for a bit. They move in lockstep with the Fed funds target rate. So until we really see monetary policy move, I can imagine the benchmark rate, such as LIBOR, will be quite anchored, which therefore has an impact on the rest of the curve as well. So given that I think interest rates will stay low for the next 6 months, after 12 months, hard to opine on that. I would say we're going to continue to see a lot of capital out there, a lot of deals get done. I still envision industrial and multi being the darlings of the asset classes. And I will give you one stat on industrial that was pretty astounding, which supports the reason why I think it's a asset class that would still stay a darling. Industrial right now originations in the first half of 21 is $39 billion. That's up 172% from the year prior. So it is definitely a favorable sector that I continue seeing, be a hot commodity for the next year ahead.
That's because Blackstone's buying everything.
Yeah, exactly.
That's definitely one reason for the 172.
Abby, what do you guys think? Are we going to be at this breakneck speed in Q1, Q2 of next year?
I think so. Yeah, I mean, it's interesting.
Will we get to sleep before then?
Yeah, the market is priced so efficiently, it's priced to perfection, but there still seems to be inefficiencies I'm finding when I'm looking at deals. Part of it is because there's just so much deal flow. And it's there, you mentioned how many debt funds are out there, but there's still just, for a year there, we all had capital, but there were no deals.
Right.
Now the deal flow has really come back, and speaking of pent-up demand, and I just think that you can find opportunities where not every lender's showing up, not every, every credit group looks at asset classes and markets a little bit differently. We're all able to kind of pick our spots. So I would just think that would continue.
Yeah. And I know that we have no bank representatives here, but is this alternative investment financing debt funds space only going to grow? Is it the end of time for our big bank friends? Well, what do you think, Lisa?
Having spent the last decade at a bank, I think that the way we used to think about it in my old seat was, the debt funds and the alternative lenders come into the market, and then something happens in the market, and then suddenly they pull back, right? So it's a little bit of a finicky part of the market, and so you always think about it as you're always going to have your space as a bank lender, right? And if you look at what the banks are doing in terms of volume this year, it's pretty much keeping on pace with last year. And especially the CMBS market, that's a $100 billion market at extremely thin spreads. So, you kind of wonder at what point, are the alternative lenders going to be able to take some of that away? In general, I don't see it with the amount of capital that's in here and the amount of people that are raising perpetual capital. It's no longer just, strict timeline type capital, but perpetual capital that they can continue to reinvest. I think that's going to be here for a long time, so long as there's not another black swan event, but the market was able to absorb that black swan event very efficiently and continue to absorb very low yields. So in my mind, this should continue into the next 12 months.
Yeah. And if yields, if rates stay this low and, especially having investors and wanting that return, do you see yourself continuing to sort of move up the capital stack and think of new ways to find more yield on these deals?
I would argue that real estate private debt as compared to most fixed income products is still a pretty attractive risk-adjusted return. So I think despite rates being so low and the market being priced to perfection, I still think we're providing a return that's pretty attractive versus a lot of other alternatives. So, I don't see yields going up, but I'm sure there are groups that'll be out there chasing it.
And you can also chase yield by pivoting your strategy on what asset class you're now lending on as well, which I was just mentioning with that whole frustrated capital concept. If you are chasing a little bit more yield, maybe you are going to target some more retail, office, or hospitality.
Right.
Or niche asset classes have really come into favor. So life science,
Yeah.
production space, focused on the Netflix and the Amazon and the content race. Single family rental has become a huge niche asset class. So there are all these asset classes that I think when we were starting out our careers, like either didn't exist or were very hard to underwrite, have now really come into favor.
Absolutely.
Yeah. And how do you see that transitioning as we all are sort of going back to normal life and going back to brick and mortar stores and whatnot? Do you, presumably the Amazons and the eBays and whatnot are not going away, and Amazon is going to be building warehouses all across the country at record speed for the foreseeable future. But do you see retail coming back in any way?
So this is what I'll say on retail. Not all retail is created equal. There are still some really strong shopping centers out there with grocery anchored that recently just priced a CMBS 10-year full-term IO, 60% leverage, sub 3%. And that was because it was grocery anchored. So you're still seeing some great pricing and deals get done within the retail sector because once again, it's not all created equal.
The commentary around the market tends to be pretty emotional, right? So people are talking about, Class B office being totally obsolete and completely out of favor, and oh my God, what are we going to do with all this Class B office that nobody's ever going to come to work again? And the pandemic effects are going to be felt for the next 20 years. Well, if you're seeing this immense flight to quality, right, especially in major gateway cities, and all the Class A inventory, and from a leasing perspective, is really getting gobbled up right now. So if Class A inventory all gets gobbled up, and then you have these more secondary type tenants that can't afford $120 per foot plus rents, right? They're going to have to go to something other than a Class A building. And especially if everyone else is returning to office, they're going to need space. Whether it's a hybrid space or not, you're still going to need to have a footprint in some of these major gateway markets. So naturally, if all the Class A product is gobbled, that has to lead to some of the Class B product being gobbled up too. So it's such an emotional, such a swing to one side, but how could that possibly be true when you start to see people returning to normalcy? And we've only scratched the surface in terms of what that return to office and what the hybrid schedules are going to look like. So in my mind, it's the same thing for retail.
Yeah.
You can't assume that all retail, yes, none of it is created equal. You can't assume that all retail is obsolete. There has to be some alternative use case for that, whether it's experiential or something else.
On the office point, right, co-working and sort of co-working space was growing more and more pre-pandemic, and then there was talk sort of when we were in the middle of it that would really be gone for good because one, no one's going back to the office ever, and if they are, they're not going back to communal spaces. Everyone's going to be in bubbles. So what do you think the future is for co-working?
I think there's a place for co-working. Is it the footprint that WeWork created pre-COVID? Probably not. I used a WeWork during COVID when I was on garden leave and I needed an office to do some things. I was going to WeWork. So, I think that it serves a purpose. I think like a lot of asset classes, if supply creation outstrips demand too dramatically, like it did with the WeWork space, or in New York, we had supply issues in hospitality and office pre-COVID. I mean, if that dynamic is happening, I think obviously that creates an imbalance and you see a correction like you've seen in the co-working space. But I think that going forward, there will be a use case for that. I mean, I think what's interesting for COVID, when you look at the effect on the actual real estate, is it really just accelerated a lot of changes that were already beginning to happen. I mean, work from home and hybrid working was already a thing before COVID. It just accelerated, COVID just accelerated that. Retail, e-commerce, and the effect on retail, that was already a huge theme in the market. That's just accelerated. So I think some of, another example, moving from New York or from primary cities to high growth secondary cities because of, quality of life and tax regime issues, people were moving to these cities. That just accelerated as well during COVID. So a lot of these things trends we've seen happening in COVID were kind of already happening before. It's just been accelerated.
I'm a big believer in co-working, and not just because I'm personally biased, because my husband owns a company that has a large portion of its cash flow as co-working. But I believe in the thesis that the traditional office 10-year leases for companies that sometimes only have maybe a 12 to 24 month look forward in terms of what their footprint needs are going to be, and having to offer some flexibility with respect to those companies, I believe in that thesis. And I think that that's something that's certainly going to come in this post-pandemic environment, right? If you're having a hybrid environment, how many of your employees are coming back to work? What's your footprint that you're actually going to need? So the co-working companies, especially from an enterprise user perspective, certainly offers larger companies the flexibility and the footprint that they may need. So the old school way of saying, I'm going to sign a lease for 600,000 square feet, yes, that works for some of the major corporations. Does that work for some of the smaller companies or even companies that don't know what their footprint's going to look like? No, it doesn't. So you have to offer some kind of flexibility, and the co-working companies really do offer that.
Yeah. Well, I know we're wrapping up, and so maybe we'll do some fast questions. I'll go down the line and get your thoughts on some things. ABBE, best market to invest in right now?
Raleigh-Durham, second fastest growing city between now and 2030.
And what are you investing in there? Are you doing multi, or are you doing?
I actually recently closed a hotel investment there, debt investment.
All right.
Nice.
Julian, we touched a little bit on, you had mentioned this before, on ESG. Where do you see that in the next 6 months? Is it C-PACE? Is it lenders getting comfortable with other ESG initiatives? Like, where do you see that going?
I could speak a lot on C-PACE, so I'll keep it short, but C-PACE stands for Commercial Property Assessed Clean Energy, and it's really an initiative that is out there so that you are incentivizing developers to keep buildings up to code and to really encourage energy efficiency within your structures. And the way they're incentivizing it is through a really nice, efficiently priced financing tool called C-PACE. It just went live in New York City in May, so I think it's going to be a topic that becomes more and more prevalent. They just closed the second C-PACE loan, and the reason why it's interesting is because it's non-recourse financing, long-term, 25 years, and it's priced with a 5 handle, 5.5% money. So when you are talking about hotel industry, which was a quite challenged sector this past year and a half, where they could use this access to liquidity and have it efficiently priced, it's going to be really instrumental. Right now, if you got a hotel construction loan, it's non-recourse, in some cases you're getting 7-8% money. So to layer in something with a 5 handle and bring the weighted average cost of capital down, it's very interesting. And that's just the tip of the iceberg, but I think it's a topic that gets more prevalent because it just went live in New York a few months ago.
Okay. And Lisa, what keeps you up at night for looking forward to the next 6 months?
I worry about inflation, and then naturally I think that leads to worrying about housing and where rent prices are going. So from my mind, I think you think about inflation, you think about cost to build, you think about employment, and you marry all those things together, and that could lead to some volatility over the next 6 months.
I think we have 5 seconds left. Anything else?
I think the best market to invest in is New York, personally.
Yeah.
I agree. There you go.
Always bet on New York.
Well, it was amazing to be here in person with you ladies, and to hear everything that you have to say. It seems like we will all be busy for the next few months, so I guess that's good.
Thank you.
Thanks.
Thank you.
Thank you.